Episode 3, The Canadian Regulatory Environment. Introduction. Welcome back to Money Talks, your guide to the Canadian Securities Course. My name is Rita, and I am your host. In our previous episodes, we explored the dynamic Canadian investment marketplace and the powerful forces of the economy that shape it. Today, we delve into a crucial aspect that underpins trust and stability in our financial system, the Canadian regulatory environment. Imagine a bustling highway without traffic laws or police officers. Chaos, right? The financial markets are no different. Without clear rules and vigilant oversight, they could quickly devolve into a free-for-all, jeopardizing investors and the broader economy. That's where regulators come in. They are the guardians of fairness, transparency, and integrity, ensuring that everyone plays by the rules. In Canada, financial regulation is a complex but well-structured system, involving various bodies at both federal and provincial levels. Let's meet some of the key players and understand their vital roles. The guardians of the marketplace, key regulatory bodies. Canada's financial regulatory landscape is designed to protect investors, maintain market integrity, and promote financial stability. Here are some of the most important entities. Canadian Securities Administrators, CSA, the harmonizers host. First up, we have the Canadian Securities Administrators, or CSA. Think of them as the orchestrators of Canada's provincial and territorial securities regulators. In Canada, each of the 10 provinces and 3 territories has its own securities regulator. To ensure consistency and avoid a patchwork of conflicting rules, these individual regulators have teamed up to form the CSA. Their primary responsibility is to develop a harmonized approach to securities regulation across the country. This means they work together to design policies and regulations that are consistent, streamlining the regulatory process for companies and market participants. This collaboration helps avoid duplication of work and makes it easier for businesses to raise capital and operate across Canada. One significant achievement of the CSA is the passport system. This system allows a market participant to access markets in all passport jurisdictions by dealing with only one principal regulator and complying with a single set of harmonized laws. This has been a major step forward in improving Canada's securities regulatory system, making it more efficient and accessible. Beyond rulemaking, the CSA also plays a crucial role in investor education. They provide a wide variety of educational materials to help Canadians understand the securities industry, navigate the stock markets, and protect themselves from investment scams. Their efforts are vital in empowering investors to make informed decisions. Canadian Investment Regulatory Organization, CIRO, the self-regulators. Next, let's talk about the Canadian Investment Regulatory Organization, or CIRO. This is a particularly important body because it's a self-regulatory organization, SRO. What does that mean? It means that CIRO is responsible for overseeing its own members, like investment dealers and mutual fund dealers, and the trading activity on Canada's debt and equity marketplaces. They set and enforce rules of conduct and financial requirements for their members, ensuring that they operate with integrity and professionalism. CIRO was formed on January 1, 2023, through the amalgamation of 2 previous SROs, the Investment Industry Regulatory Organization of Canada, IIROC, and the Mutual Fund Dealers Association of Canada, MFDA. This consolidation aimed to create a more efficient and effective regulatory framework for the investment industry in Canada. CIRO's role is critical in maintaining investor confidence and market integrity by ensuring that firms and their representatives adhere to high standards of practice. Let me share with you the latest news that will make a major shift in the industry. Starting January 1, 2026, the Canadian Investment Regulatory Organization, CIRO, will implement a new exam-based proficiency model for investment dealer personnel, replacing the previous course-based requirements. This reform, developed over several years, eliminates mandatory courses and introduces 9 role-specific exams across 11 registration categories, aiming for greater flexibility and affordability. Materials, including syllabi and practice exams, are gradually being released, starting with the Canadian Investment Regulatory Exam, CIRE. The partnership with CSI ends December 31, 2025, and transitional rules allow individuals to complete CSI-based requirements within a year after enrolling before that deadline. Mandatory code of conduct training will be required. New registrants must complete it within 30 days of approval post-Jan. 1, 2026, while current registrants must do so by the end of 2026. Continuing education, CE requirements, and baseline education/experience standards will also be updated and finalized by summer 2025. Current registrants staying in their roles, with no break over 180 days, are exempt from the new exams but must meet the new CE and conduct standards. Office of the Superintendent of Financial Institutions, OSFI, the prudential watchdog. Our next key player is the Office of the Superintendent of Financial Institutions, or OSFI. While the CSA and CIRO focus on securities markets and investment firms, OSFI has a broader mandate. They are the primary regulator and supervisor of all federally regulated financial institutions in Canada. This includes banks, insurance companies, trust and loan companies, and pension plans. OSFI's main objective is to protect depositors, policyholders, and pension plan members from undue loss. They do this through a system of prudential regulation and supervision, ensuring that these institutions are financially sound and operate in a safe and sound manner. They set capital requirements, conduct risk assessments, and intervene when necessary to address potential vulnerabilities. Think of them as the financial system's stability engineers, working to prevent systemic risks that could impact the entire economy. Investor protection funds, the safety net. Even with robust regulation, sometimes things can go wrong. That's where investor protection funds come in, acting as a crucial safety net for investors. In Canada, two prominent examples are Canadian Investor Protection Fund, CIPF. The CIPF provides protection for eligible customers of CIPF member firms, primarily investment dealers, in the event that a member firm becomes insolvent. It protects customer assets, such as cash and securities, held by the firm, up to certain limits. This provides peace of mind for investors, knowing that their assets are protected even if their investment dealer faces financial difficulties. Canada Deposit Insurance Corporation, CDIC. The CDIC protects eligible deposits made at CDIC member institutions, which include many banks, trust companies, and loan companies. If a CDIC member institution fails, the CDIC ensures that depositors get their money back, up to a specified limit. This is vital for maintaining confidence in Canada's banking system. To sum up, today we've navigated the intricate world of Canada's financial regulatory environment. We've seen how the Canadian Securities Administrators harmonize rules across provinces, how CIRO self-regulates investment firms, how OSFI acts as a prudential watchdog for financial institutions, and how investor protection funds like CIPF and CDIC provide a crucial safety net for investors. This robust regulatory framework is designed to foster a fair, transparent, and stable financial system, giving investors confidence and promoting the healthy functioning of our capital markets. In our next episode, we'll dive into the world of fixed-income securities, exploring how bonds and other debt instruments play a vital role in both government and corporate finance. Join us next time on Money Talks, your guide to the Canadian Securities Course.